Imagine a financial move where you make a significant profit, a truly substantial gain, and yet you don't have to pay taxes on it immediately. Sounds almost too good to be true, doesn't it?
It really does sound like that sometimes.
Well, today we're not just imagining it, we're diving deep into the fascinating and very real world of non-taxable dispositions.
Mm-hmm.
These are specific, powerful provisions in the tax code that can legally keep more money in your pocket, either by never recognizing a gain at all or by, postponing that tax bill far into the future.
Right, and this isn't about shady loopholes or anything.
No, not at all. This isn't about avoiding taxes. It's about incredibly smart financial strategy built right into the rules, designed to help you reinvest, grow, and, frankly, thrive.
Exactly.
Our mission in this deep dive is to demystify these provisions, review their true power, and give you the essential knowledge to spot these opportunities and understand when a gain you've realized isn't necessarily a gain you'll recognize for tax purposes. That distinction is key.
It really is.
Yeah.
And what's truly fascinating here is the underlying philosophy. The tax code isn't just a mechanism for collecting revenue, it's also a powerful tool that incentivizes certain economic behaviors.
Like reinvesting.
Things like reinvestment, promoting homeownership, or ensuring continuity of investment are all encouraged through these very specific rules. They are absolutely crucial for both individuals and businesses looking to optimize their financial outcomes, ensuring that a significant life event or a simple asset transaction doesn't trigger an immediate, maybe devastating tax burden, especially when your fundamental investment hasn't really changed its character.
Okay.
At its core, any gain or loss is generally calculated by comparing the amount realized from selling or disposing of an asset to its adjusted basis. But we're going to explore those critical, often game-changing exceptions where a gain is indeed realized, meaning you've actually made a profit, but crucially, not recognized.
Not recognized meaning not taxed yet.
Not taxed in that moment, exactly. This is where strategic tax planning truly comes to life.
So let's break that down, because this distinction between a gain you make and a gain you pay tax on is absolutely foundational to understanding today's discussion. For many, I think, they seem like the same thing.
They can do, yeah.
But in the world of taxes, they are two very different beasts. When you sell something, whether it's a piece of property, a stock, or even equipment, you calculate what's called your realized gain or loss. This is your raw, factual profit or loss from that transaction.
Right. The calculation itself is pretty straightforward.
Yeah, the formula is, well, you take the amount realized from the sale. This includes any cash you received, the fair market value of any property you were given, and even like the cancellation of any debt you were relieved from.
Minus selling costs.
Right, all minus any selling expenses like commissions or closing costs.
Right.
From that amount realized, you then subtract the adjusted basis of the asset you sold.
Okay, and the adjusted basis. That's usually what you paid for it.
Typically your original purchase cost, yeah. But it can also be a rollover cost if you receive the asset as a gift, or maybe a stepped-up fair market value if you inherited it.
Right, that step up is important.
Definitely. The number you end up with after this subtraction is your realized gain or loss. That's the actual financial profit you've made on paper.
Precisely. And this leads us right to the core question. Why would the IRS, the tax authority, allow a realized gain to go untaxed, even temporarily?
Yeah, why?
Well, the various provisions we'll explore today are built on a very specific idea that the taxpayer's investment has not substantially changed its form or purpose.
Okay, so you're still invested, just maybe in a slightly different way.
Exactly. Therefore, recognizing the gain or loss and thus taxing it immediately would create an unfair or maybe economically inefficient burden. This deferral or exclusion isn't a magic trick that makes the gain disappear forever, in most cases.
Right, it usually catches up eventually.
It's often achieved by effectively substituting the basis of the old property for the basis of the new property. This ensures that the original gain is tracked and accounted for, typically for future recognition, when the new property is eventually sold in a taxable transaction.
Okay, so the gain kind of embedded in the new property's basis.
You got it. To help you remember these key provisions that allow for such deferral or exclusion, we've organized them into a handy acronym. HIDE it.
HIDE ID. Okay, what does that stand for?
It stands for Homeowners Exclusion,
Okay.
Involuntary Conversion, Divorce Property Settlement,
Right?
Exchange of like-kind property.
The big word.
Yeah, installment sale, and treasury capital and stock. That's by a corporation.
HIDEIT. Got it.
This mnemonic captures the core principle we're discussing today. Some of these gains are excluded, meaning they are never recognized for tax purposes, effectively disappearing from your taxable income up to certain limits.
Like the homeowner's one.
A great example is the homeowner's exclusion. Others are deferred, meaning the gain is recognized later. Think of a like-kind exchange or an involuntary conversion. The gain isn't eliminated, but its recognition is postponed into the future.
Pushed down the road.
Exactly. A critical element to understand with these deferral provisions is that the basis in your new property and your holding period generally carry over from the old property.
Okay.
This is how the original gain is tracked for future recognition. It's all about ensuring continuity of investment and avoiding an immediate tax hit when your economic position hasn't truly changed.
That's a powerful framework to keep in mind as we journey through these rules. Let's kick things off with one of the most common and truly powerful tax-saving opportunities for many of us, selling your personal principal residence.
Yeah, this affects a lot of people.
This is where it gets incredibly relevant for anyone who owns a home, because the gain you make on the sale of your personal principal residence may be eligible for a very significant exclusion from your gross income.
Huge potential savings.
This means a substantial chunk of your profit, potentially hundreds of thousands of dollars, just won't be taxed at all. Now, a quick but very important note up front. While gains can be excluded, any losses you incur from the sale of a personal principal residence are not deductible.
Right, that's a key point. It's personal use.
That's because it's considered a personal use asset, and generally the tax code doesn't allow deductions for losses on personal use property.
The rules for the homeowner's exclusion are, as you said, designed to strongly support homeownership and provide a truly substantial benefit. The exclusion amounts are quite generous.
How much are we talking?
A full $500,000 of gain is available for married couples filing a joint return, and also for certain surviving spouses.
Wow, $500,000 tax-free.
Potentially, yes. And for single individuals, those married filing separately or those filing as head of household, the exclusion amount is $250,000.
Still very significant.
These figures can represent a monumental difference in your financial outcome when you sell your home, potentially saving you tens or even hundreds of thousands of dollars in taxes. Now, qualifying for this exclusion hinges on what we call the 2 out of 5 year rule.
The 2 out of 5 rule.
To unlock the full exclusion, you must have owned the property and used it as your principal residence for 2 years or more during the 5-year period ending on the date you sell or exchange it.
Owned and used for 2 years within the last 5.
Correct. And what's crucial to grasp here is that these periods of ownership and use do not have to be continuous.
Ah, okay. So you could live there a year, move out, move back.
Exactly. They also don't necessarily have to cover the exact same 2-year period within that 5-year window. Let's illustrate with a common scenario. Imagine a single taxpayer who buys a home and lives in it for just 1 year.
Okay.
Then, an amazing career opportunity arises, requiring her to move to a new city for 2 years. During that time, she rents out her house but continues to own it.
Right. Keeps owning it.
After 2 years, she returns, lives in the house for another year, and then decides to sell it. Does she qualify for the exclusion?
Let's see. Owned for 4 years total, lived there 1 year, then another year. So 2 years of living there within the last 5.
Yes, absolutely yes. Despite the 2-year rental period, she owned the house for a total of 4 years and lived in it for 2 years, 1 year initially, 1 year upon return, within the 5-year period leading up to the sale. She meets both the ownership and use tests. So even with a break in residency, the exclusion can still be claimed.
That's really flexible.
It is. Now, there are also important nuances for married taxpayers. For a couple filing a joint return to claim the full $500,000 exclusion, at least one spouse must meet the ownership requirement.
Okay, one owner is enough.
But both spouses must meet the use requirement with respect to the property.
Both have to live there for 2 years.
That's the key. Both partners need to have lived in the home as their principal residence for 2 of the past 5 years. If only one spouse meets the use requirement, you may still be eligible to take the single $250,000 exclusion.
Okay, so not the full $500,000, but still something.
Right. For example, if a taxpayer owned and lived in their home for 3 years, then got married, and their spouse moved in, and they sold the home after just 1 year of marriage.
Spouse only lived there 1 year.
Exactly. So only $250,000 of the gain could be excluded. This is because, while the original owner met the 2-year use test, the spouse did not meet it.
Makes sense. What about surviving spouses?
For surviving spouses, there's a special compassionate provision designed to ease financial burdens during a difficult time. If a widow or widower sells a home that they owned and occupied with the decedent spouse, the surviving spouse is entitled to claim the full $500,000 exclusion,
Full amount.
provided they sell the home within 2 years after the date of the decedent spouse's death.
Okay, that's good to know.
It's also incredibly important to highlight that there is no age requirement whatsoever to receive this exclusion. You don't have to be retired or over a certain age.
Doesn't matter how old you are.
Nope. Furthermore, there's no requirement that you must purchase another personal residence to qualify. This isn't a rollover provision like some older tax laws.
You don't have to buy a new house.
Correct. And here's another powerful takeaway. This isn't a one-time deal. The exclusion is renewable.
Really? You can use it more than once.
You can utilize the homeowner exclusion as often as you meet the ownership and use requirements, though you can't use it more frequently than once every 2 years.
Okay, there's a limit, once every 2 years.
Right. So theoretically, if you move every few years buying and selling principal residences, you could keep benefiting from this major tax break multiple times throughout your life, making it a cornerstone of smart financial planning.
That's an incredibly generous provision, truly a cornerstone for many. But what if life throws an unexpected curveball and forces a sale before you meet the full requirements? Say you only live there a year and a half. Is all lost? Or does the tax code offer some relief?
Thankfully, it does. This is where the hardship provision comes into play, offering a compassionate safety net. Taxpayers may be eligible for a reduced exclusion if the sale is due to an unforeseen circumstance.
Like what kind of circumstance?
This explicitly includes a change in place of employment, a health issue, or other specific unforeseen events. This provision is vital if you've claimed the exclusion within the previous 2 years, or if you simply didn't meet the full 2-year ownership and use requirements before you had to sell.
So it helps if you're forced to sell early.
Exactly. Under this provision, the maximum exclusion you can claim is calculated proportionally based on how many months you did qualify, relative to the standard 24-month minimum.
So it's prorated.
Basically, yes. To calculate this reduced exclusion, you simply take the number of qualifying months of ownership and divide it by 24 months. Then multiply that fraction by the maximum exclusion available to you based on your filing status, $250K or $500.
Okay.
For instance, if your employment changes, there's a specific rule. Your new job location must be at least 50 miles farther from the residence you sold than your previous job was.
Has to be a significant move.
Right. Ensures it's a qualifying move.
Hmm.
Let's consider an example with a health-related sale. Imagine a single taxpayer who buys her home and lives in it as her principal residence for exactly 1 year, 12 months.
Okay, halfway there.
Then, sadly, she receives a diagnosis of a serious health condition, leading her to sell her home to move in with her daughter for care. Let's say she makes a gain of $150,000 on the sale.
Okay.
Even though she didn't meet the full 2-year ownership test, she's eligible for a reduced exclusion under the hardship provision. The calculation would be 12 months of qualifying ownership divided by 24 months.
Which is half, 0.5.
Right, 0.5. You then multiply that by her $250,000 maximum exclusion. So 0.5 times $250,000 equals $125,000.
So she can exclude $125,000.
Exactly. Out of her $150,000 realized gain, $125,000 would be excluded from her income, and only $25,000 would be a recognized taxable gain. It's a remarkably thoughtful aspect of the law, acknowledging life's unpredictable and difficult challenges.
That's a critical safety net, allowing for flexibility when life throws those unexpected curveballs.
Yeah.
But what about when a home has been used for something other than a primary residence at some point? Say you rent it out for a while. How does that factor into the exclusion?
That's an excellent and very common question, and it brings us to the non-qualified use provision, which applies to any non-principal residence use of the home on or after January 1st, 2010.
Okay, so using it as a rental, for example.
A non-qualified use is, simply put, any period during which the home was used for something other than your principal residence. This could be renting it out or using it as a vacation home, for example.
Right.
The crucial point here is that the overall exclusion amount itself isn't adjusted. You still have your $250,000 or $500,000 maximum, but the portion of the gain attributable to that non-qualified use is not eligible for the exclusion.
So part of the gain might be taxable?
That part of the gain will be taxable, yes. To calculate this, you determine the ratio of the period of non-qualified use divided by the total period of time you own the property.
Non-qualified time over total ownership time.
Exactly. Then you multiply that ratio by your total realized gain. For instance, let's revisit our single taxpayer scenario from earlier. She lived in her home for 1 year, then rented it out for 2 years while working in another city, then returned and lived in it for one more year before selling.
Okay, owned 4 years, lived there 2, rented 2.
Right. Let's say she sold it for a total realized gain of $50,000. Her total ownership period was 4 years. 2 of those years were considered non-qualified use when it was rented out.
So 2 divided by 4.
Correct, 50%. Multiply that by her $50,000 total gain, and you get $25,000. This $25,000 portion of her gain is not eligible for the exclusion, and it would be recognized as a capital gain.
Okay, so 25K is taxed.
But the remaining $25,000 of her gain, however, is excludable, assuming it falls within her $250,000 maximum.
Got it.
Now, here's a very important clarification, and it's a friendly rule for taxpayers. The period of non-qualified use does not include any portion of the 5-year period ending on the date of sale that occurs after the last date the home was used as your principal residence.
Wait, say that again. The time after you move out doesn't count as non-qualified use.
Generally, yes, for the purpose of this calculation. Think of it this way. If you live in your home for many years, then move to a new city, the time it takes for you to sell that old house, even if it sits empty for months or you rent it out temporarily after you've moved out, generally doesn't count against your exclusion for non-qualified use purposes.
Wow, that seems really generous.
It is. This rule is designed to be very taxpayer-friendly, allowing you ample time to sell after you've moved without being penalized. For example, if you lived in your home for 4 years, then moved, and the house sat empty for 3 years while it was for sale before finally selling,
That empty time doesn't hurt you.
your entire gain could still be fully excluded up to the maximum amount. The period it was empty and available for sale after you stopped using it as your principal residence isn't treated as non-qualified use for calculating this taxable portion. It's a thoughtful aspect of the law designed to ease the burden of selling property after a life change.
That's a great example of the tax code offering a bit of empathy for life's unexpected turns. It's almost saying we understand bad things happen. Let's shift gears to the I and hide IT. What happens when your property is destroyed, stolen, or even condemned by the government for public use? This is what's known as an involuntary conversion.
Right. And if we connect this to the bigger picture, the rationale behind these rules is very simple and humane. To tax someone immediately after a forced, unforeseen event like a fire, theft, or government condemnation would create undue financial hardship.
Yeah, that seems fair.
The primary goal of the involuntary conversion rules is to allow the taxpayer to be restored to their prior economic position without immediate tax consequences, provided they reinvest the proceeds into similar replacement property. It's a mechanism for financial continuity during disruption.
So if you reinvest, you might avoid the tax hit.
Generally, yes. You usually won't recognize a gain in 2 main scenarios. First, if you directly receive other similar property as a replacement for your involuntarily converted property.
Like a land swap with the government.
Exactly. Second, and more commonly, if you reinvest all the insurance proceeds or condemnation award you received into property that is similar or related in service or use.
Okay, reinvest everything.
However, if you receive proceeds and you don't reinvest all of them, then gain is recognized, but only to the extent of the amount you didn't reinvest.
Ah, the part you keep is taxed.
Right, up to your total realized gain. So if you received $100,000 in insurance proceeds from, say, a fire, and only reinvested $80,000 in rebuilding or replacing,
You kept $20,000.
then $20,000 of your realized gain would be recognized. This is often referred to as receiving boot in this context, similar to like-kind exchanges.
Okay, and the reinvestment has rules too, right? Time limits. Type of property.
Absolutely. The reinvestment must occur within specific timeframes and, importantly, in similar property. The standard for similar or related in service or use is quite narrow.
Narrower than like kind.
Much narrower,
Right.
usually. It means the replacement property must serve the same function or purpose in your business or life as the old property did.
So replacing a factory with a factory.
That would generally qualify, yes. But replacing a factory with apartment buildings might not, unless perhaps you are purely a real estate investor in both cases, and the nature of your investment risk remained similar. It's a stricter test.
Got it. What about the time limits?
As for the reinvestment periods, generally you have 2 years after the close of the taxable year in which any part of the gain was first realized to reinvest the proceeds.
2 years from year end.
Right. However, there are extended periods for certain situations. If your principal residence is destroyed in a federally declared disaster area, the replacement period extends to 4 years instead of 2.
4 years for disaster zones. Makes sense.
And for real property held for use in a trade or business or for investment that is converted by seizure, requisition, or condemnation, but notably not by theft or destruction, the replacement period is 3 years.
3 years for condemnation of business investment real estate.
Correct. It gives a bit more breathing room.
Okay, and what about the basis in the new property? How does that work?
Good question. When it comes to the basis in your replacement property, if you directly receive similar property as replacement, its basis is simply a substituted basis. It's the same as your old property.
Just carries over.
Yep. If you acquire similar property by reinvesting proceeds, the basis of that new property is its cost, decreased by the amount of any gain you didn't recognize or deferred on the involuntary conversion.
Cost minus the deferred gain.
Exactly. And importantly, the holding period of the new property includes the holding period of the involuntarily converted property, preserving your original investment timeline.
So the history carries over too.
Right. Let's quickly illustrate. Suppose a taxpayer had land with an adjusted basis of $30,000. It was condemned by the state, and the taxpayer received similar land directly from the state as replacement. In this case, the basis of the new land is simply $30,000 carrying over from the old land. The gain is deferred.
Simple enough. What about the boot situation?
Now, what if you receive cash that exceeds your reinvestment cost? This is where a portion of your realized gain becomes recognized. The basis of the replacement property is its cost, less the gain that was deferred.
Okay, let's see an example.
Imagine a building owner had a building with an adjusted basis of $400,000. The state condemned it and awarded $450,000.
So a $50,000 realized gain.
Correct. $450K precedes $400K basis. The owner then bought a new, similar building for $440,000.
Okay, reinvested $440K out of $450K. Kept $10.
Precisely. Since they only reinvested $440,000, they recognized only $10,000 of that gain. $450,000 proceeds minus $440,000 reinvested.
Taxable gain is 10K.
Right. The remaining $40,000 of gain, $50K realized, $10 recognized, is deferred. The basis of their new building would then be its cost of $440,000 less the $40,000 deferred gain.
Which makes the new basis $400,000.
Exactly. $400,000. It's worth noting that for gains over $100,000, property acquired from related parties generally doesn't qualify as replacement property, which is a key detail for larger transactions.
Good point about related parties. Now, what if it's a loss? Say the insurance isn't enough.
That's different. Unlike gains, losses from involuntary conversions are generally recognized. The rules for non-recognition apply only to gains.
So you can deduct the loss.
Typically, yes. If you incur a loss, you can usually recognize it. For example, if a factory with a cost basis of $340,000 was destroyed by fire and the insurance company paid only $330,000, that's a $10,000 loss.
Okay.
This $10,000 loss would be recognized immediately. If a new plant was then bought for $500,000, the basis of that new factory would simply be its replacement cost of $500,000. So it's not a deferral in the same way. It's a clear recognition of the loss.
Okay, that covers it in.
Huh.
Let's move to D and hide IT divorce property settlements. In the midst of something as personally transformative as a divorce, the tax implications of property division can be a huge source of anxiety and concern. Fortunately, the tax code offers a remarkably clear and helpful rule here that simplifies things significantly.
This provision is indeed straightforward, but incredibly important for minimizing additional stress during what is already a challenging time. Generally speaking, a property settlement in the context of a divorce is considered a non-taxable event.
Non-taxable.
Ah.
Meaning no tax consequence at the time of transfer.
Exactly. This means neither the transfer spouse nor the recipient spouse will recognize a gain or loss on the transfer of property between them. It's designed to be completely tax neutral at the point of transfer.
That seems helpful.
It is. The key financial implication here, and what you really need to understand as the recipient spouse, is that the basis of the property for you is a carryover basis.
Carryover basis.
Yeah.
Meaning you get their basis.
What does that mean? It means you take the property with the exact same basis that the property had in the hands of the transfer spouse. It's as if you originally acquired it yourself at their cost.
Okay, so the potential gain is still there, just deferred until I sell.
Precisely. Furthermore, the transfer's original holding period for the property also carries over to the recipient spouse.
Holding period too.
Okay. This rule applies uniformly, regardless of whether the property was separately owned by the transferor or if it was a division, equal or unequal, of community property.
Even if there's debt involved.
Even if the transferred property is subject to liabilities that exceed its adjusted basis, which can sometimes be a sticky tax situation, these non-recognition rules still apply, with the notable exception of property specifically held in trust.
So, generally, it's clean.
The profound benefit of this rule is that it allows divorcing couples to divide their assets based on their true economic value and needs, without the immediate specter of a large tax bill adding another layer of complexity to an already difficult process. It essentially defers any potential tax event until the property is later sold by the recipient spouse. So while it's non-taxable now, the original gain is still baked into the basis for when the recipient eventually sells it down the line.
Okay, that's D. Now for E, exchange of like-kind property. This is a big one, a true powerhouse provision for real estate investors and business owners. The like-kind exchange, or Section 131 exchange, is one of the most talked about and strategically used provisions in the tax code for those looking to manage and grow their real estate portfolios without triggering immediate capital gains.
Absolutely. If we connect this to the bigger picture, the 1031 exchange allows for the deferral of gain when real property held for productive use in a trade or business or for investment is exchanged for other real property of a like kind.
Real property for real property.
That's the key now. The core intent here is to encourage continued investment in real estate and the broader economy by removing the immediate tax barrier that a direct sale might otherwise create. It essentially says, if you're keeping your capital invested in the same asset class, we won't tax you on the paper game until you truly cash out.
You said real property. What about other stuff?
Right. Now, a critical distinction, and this is a significant change in recent tax law. As of January 1st, 2018, like-kind exchanges are strictly for real property.
Strictly real estate.
Correct. This means that exchanges of personal property, things like equipment, vehicles, art collections, or even certain types of intangible assets, no longer qualify for non-recognition treatment.
So no more swapping company cars tax deferred.
Nope, that's gone. This is a very important point for business owners who previously used 1031s for things like fleet vehicle upgrades or machinery.
Okay, so give me an example of qualifying real property.
Let's illustrate the qualifying property aspect. If a taxpayer owned a commercial building where she ran her clothing boutique, and upon retiring from that business, she exchanged that building for an apartment building that she intended to hold as an investment.
Business real estate for investment real estate.
That would qualify. She exchanged real property used in a business for other real property held for investment. That's a valid like-kind exchange. However, if that same business owner exchanged several laptop computers for a new set of office furniture.
Both personal property.
Right. This would not qualify under current 1031 rules as both are personal property. The focus is squarely on real estate now.
Okay, focus on real estate. What else is crucial? I hear the timing is tricky.
Beyond the type of property, there are absolutely strict and crucial timing requirements that must be met for a like-kind exchange to receive deferral treatment. Missing these deadlines means your exchange will not qualify and your realized gain will become fully recognized and taxable.
Okay, what are the deadlines?
First, you must identify your like-kind replacement property within 45 days of giving up your original property.
45 days, that's really fast.
It is a very tight window, and it's absolute no extensions. You need to provide a clear, unambiguous written identification of the property you intend to acquire.
Written ID within 45 days, then what?
Second, you must actually receive the like-kind property by the earlier of two dates, either 180 days after you transferred your original property in the exchange, or the due date of your income tax return, including extensions, for the year in which the transfer occurred.
Okay, 180 days total or tax day, whichever comes first.
Exactly. These dates are non-negotiable and require careful planning and often the use of a qualified intermediary to hold funds and facilitate the transaction. You generally can't just hold the cash yourself in between.
Right, the intermediary is key. So the timing is incredibly tight. That's crucial to remember. What if the exchange isn't a perfect swap? What if cash or other non-like-kind property changes hands? That introduces a concept often referred to as boot.
You're right, it rarely is a perfect swap, and that's where boot comes in. Boot refers to any non-like-kind property received in the exchange.
Like cash.
This could be cash, yeah, relief from liabilities, or any other non-qualifying property. When boot is received in a like-kind exchange, the recognized gain is the lesser of the realized gain or the amount of boot received.
Lesser of realized gain or boot received.
Okay. This is a key rule to remember. It's also crucial to understand that boot paid by you does not trigger gain recognition. It's only boot received that can make a portion of your gain immediately taxable.
So paying extra cash doesn't trigger gain for me.
Correct. In fact, paying boot can sometimes even help you defer more gain if it balances out debt relief, for example.
What about debt? That seems common in real estate.
Very common. When your exchange involves both debt assumed and debt relief, you net the debt.
Net the debt. How?
If your net position is that you assumed more debt than you were relieved of, that's considered boot paid. If your net position is that you were relieved of more debt than you assumed, that's considered boot received.
So getting rid of more debt than you take on is boot received.
Exactly. For example, if you exchange an investment property and are relieved of a $100,000 mortgage but only assume a new $70,000 mortgage, you have $30,000 of net debt relief, which is treated as boot received.
Okay, let's walk through an example with boot to make sure I get this.
Sure. Suppose a taxpayer exchanges investment real estate, which is worth $40,000 and has an adjusted basis of $25,000 for another piece of investment real estate worth $35,000 plus $5,000 in cash.
Okay, old basis, $25K, sold for value of $40K, $35K property plus $5K cashing. Realized gain is $15K.
Perfect. Step 1, realized gain is $15,000. $40,000, amount realized $25,000 basis. Now, step 2, what is the recognized gain?
It's the lesser of the realized gain, 15 or the boot received, which is the $5K cash. So $5,000 recognized gain.
Exactly. $5,000 is recognized and taxable now. Step 3, what is the deferred gain?
That's the realized minus the recognized. 15K, 5K equals 10K deferred.
You got it. $10,000 deferred gain. And finally, step 4, what is the basis in the new property?
Okay. Basis calculation. It's the fair market value of the new property, $35K minus the deferred gain, $10,
right,
plus any deferred loss, 0 here. So $35K, 10K equals $25,000.
Perfect. $25,000. Notice how the basis is essentially tracking that original deferred gain.
Yeah, links back. What about losses in 1031s? Can you deduct a loss?
No, that's an incredibly important point about like-kind exchanges. Realized losses are not recognized.
Never recognized.
If you exchange property in a like-kind exchange and you would have had a loss on a straight sale, that loss is deferred. It doesn't disappear. Instead, it increases the basis in the new property.
Increases the basis. How does that help?
So you eventually benefit from it by reducing a future gain or increasing a future loss when you eventually sell the new property. This means you can't use a like-kind exchange to recognize a loss for tax purposes immediately to offset other income.
Okay, no loss harvesting through 1031s. That distinction between realized and recognized gain and how boot impacts it is really central. Let's dig into just a couple more scenarios that frequently come up in like-kind exchanges, especially with depreciation and debt, because these are where real-world complexities often arise. We don't need to walk through every single arithmetic step, but let's understand the principles that these examples demonstrate.
Absolutely. Understanding the principles of these calculations deeply can save you a lot of headaches and taxes down the road. Let's start with a scenario where there's a realized gain but no boot involved, which is the ideal situation for full deferral.
Okay, the perfect swap.
Scenario 1. Realized gain, no boot, full deferral. Imagine a taxpayer exchanges a warehouse used solely for business for another similar warehouse to be used in the business. The original warehouse had an adjusted basis of $17,000 after accounting for depreciation. The new warehouse they receive in exchange is worth $20,000.
Okay, basis 17K, new value 20K. Realized gain is 3K, no boot.
Right. So the principle here is you've made a profit of $3,000, $20,000 value received minus $17,000 basis. Because no cash or non-like-kind property was exchanged, this entire $3,000 gain is deferred. You pay no tax on it right now.
And so what? What's the impact?
The so what is. Your basis in the new $20,000 warehouse will be $17,000. This is how the deferred gain is tracked. When you eventually sell that new warehouse for more than $17,000, you'll pick up that original $3,000 deferred gain plus any new gain you've made. It's a fantastic way to roll over your investment and avoid an immediate tax hit.
Makes sense. Okay, what about a loss situation?
Scenario 2. Realized loss, no boot, loss deferred. Let's change the facts slightly. Same scenario. Warehouse for warehouse, new one worth $20,000. But this time, the original warehouse had an adjusted basis of $23,000, meaning it was worth less than its depreciated cost.
Basis 23K, new value 20K. So a 3K realized loss.
Correct. So the principle, you've realized a loss of $3,000, $20,000 value received minus $23,000 basis. However, as we just said, in a like-kind exchange, realized losses are never recognized immediately. The rule is strictly for deferring gains.
Can't deduct it now. So what happens to the loss?
So what is this $3,000 loss isn't lost forever. It's deferred and essentially added to your basis in the new property. So your basis in the new $20,000 warehouse would become $23,000. This higher basis will either reduce a future gain or increase a future loss when you eventually sell this new property, allowing you to eventually benefit from that original loss.
Okay, so the loss gets baked into the new basis, increasing it. Got it. Now the debt situation, that seems common.
Scenario 3. Realized gain, debt assumed, and debt relief, netted debt. This is a very common and often complex scenario in real estate exchanges because debt is so prevalent. Imagine you're exchanging your old warehouse, which has an adjusted basis of $17,000, and it's also encumbered by a $5,000 mortgage, which the other party assumes debt relief for you.
Okay, 5K debt relief.
The new warehouse you're acquiring is worth $18,000, and it comes with a $3,000 mortgage that you assume, debt assumed by you.
Okay, taking on 3K debt.
First, you net the debt. You were relieved of $5,000 in debt, but you took on $3,000 in new debt. So your net debt relief is $2,000, $5,000, $3,000.
2TN net debt relief. That's boot received.
Exactly. This $2,000 is treated as boot received by you. Second, calculate realized gain. Your amount realized would be the fair market value of the new property, $18,000, plus that net debt relief, $2,000, totaling $20,000. Subtract your old basis, $17,000. So $20,000, $17,000 realized gain.
Realized gain is 3K, not how
Yeah.
much is recognized.
Third, calculate recognized gain. Remember, recognized gain is the lesser of your realized gain, $3,000, or the boot received, $2,000 from net debt relief. So $2,000 of your gain is recognized and immediately taxable.
Okay, $2K tax now. What's the impact?
The so what is, you've deferred $1,000 of your gain, $3,000 realized, $2,000 recognized. Your new basis in the $18,000 warehouse will be $17,000. It's 18K FMV minus the 1K deferred gain. This example highlights how relieving yourself of more debt than you assume can trigger a taxable portion of your gain, even in an otherwise qualifying exchange. It's a critical detail for investors who are looking to move into properties with less debt.
That netting the debt part is really key. These principles show that like-kind exchanges are powerful tools for real estate investors, allowing them to continually build their portfolios. But they absolutely require precise calculations, strict adherence to rules, and often the guidance of a professional to ensure you don't accidentally trigger an immediate tax bill.
Absolutely. Precision is paramount.
Okay, moving to the second I in Hyatt IT, installment sales. For those selling property and receiving payments over time, perhaps you're selling a vacation home to a family friend or a piece of land, the installment method can be an absolute game changer for managing your tax liability. It effectively allows you to spread out your tax bill over several years.
Exactly. This provision allows for the deferral of gain when payments for a sale extend into a tax year after the year of the actual sale. It's particularly useful for non-merchants selling personal property and non-dealers selling real estate.
So not for regular business inventory, but for occasional sales.
Right. This means individuals or businesses not regularly in the business of selling these types of assets can recognize their gain over time as they receive the cash rather than all up front. This is a huge cash flow advantage.
You pay taxes, you get paid.
Essentially, yes. It's important to note, however, that you can elect out of the installment method if you prefer to report all of the gain in the year of sale for any reason, perhaps to offset a current loss.
Oh, you can choose not to use it.
You can, but the default is usually the installment method if the sale qualifies. Under the installment method, the portion of your revenue that represents gain is reported over the period in which the cash payments are actually received, rather than all upfront in the year of sale.
Okay.
This doesn't change the character of the gain you're reporting, whether it's a capital gain or ordinary income, but it fundamentally alters when you pay tax on it. Your taxable income each year is calculated by multiplying the annual cash collections, and crucially, this excludes any interest received, which is taxed separately, by what's called the gross profit percentage.
Gross profit percentage. Okay, how do we figure that out?
Let's break down the formulas involved because they are key to applying this method. First, gross profit is simply your sales price minus your adjusted basis in the property sold.
Sales price minus basis. Got it.
Second, the gross profit percentage is your gross profit divided by your sales price. This percentage tells you what portion of each payment you receive represents taxable gain.
Okay, profit divided by sales price gives the percentage.
Right. Finally, the gain recognized, which is your taxable income, each year is your cash collections, again, excluding interest, multiplied by that gross profit percentage.
Cash collected times the percentage. Let's try an example.
Okay. Suppose a taxpayer sells a piece of land in year one for $400,000, and they've agreed to receive payments over several years. At the end of year one, they still have a balance of $150,000 in installment notes receivable. Their adjusted basis in the land they sold was $300,000.
Okay, sales 400K, basis 300K, profit is $100.
Correct. Step one, total gross profit is $100,000. Now step two, calculate gross profit percentage.
That's profit 100K divided by sales price 400K, which is 0.25 or 25%.
Perfect. 25%. This means 25 cents of every dollar of principal received is profit. Now, step three, calculate gain recognized in year one. First, we need the principal cash collections in year one.
Okay, total sales 400K, still owed 150K. So they collected 450K, 150K is 250K in year one.
Exactly. $250,000 was collected in principal payments in year one. Now, multiply these cash collections, $250,000, by the gross profit percentage, 25%.
$250,000 times 25%. That's $62,500.
Right. Gain recognized in year one, $62,500. This means only $62,500 of the $100,000 total gain is recognized in year one, with the remaining gain deferred to future years as the $150,000 in notes receivable are collected.
So they only pay tax on $62,500 now, not the full $100K. That helps cash flow.
Immensely. It allows the taxpayer to match their income with their cash flow, preventing a large tax bill before they've even received all the money from the sale.
What about interest on the loan?
Good point. Regarding interest, the seller is generally required to charge interest on an installment sale. This interest is reported separately from the principal payments as ordinary income.
So the 25% calculation only applies to principal.
Correct. And if no interest or inadequate interest is reported, the IRS may impute interest, meaning a portion of each installment payment will be treated as interest and taxed at ordinary rates, whether you intended it or not.
Okay, got to charge reasonable interest. Are there other tricky rules?
There are a few miscellaneous but very important rules to be aware of. Any depreciation recapture, specifically from Section 1245 property, like equipment, and Section 1250 property, like buildings, but usually only certain depreciation types,
Depreciation recapture?
must be included in income in the year of sale, regardless of when cash is collected. It cannot be deferred under the installment method. The IRS wants that back immediately.
Okay, recapture taxed up front. What else?
Also, if you take out a loan that is secured by the installment obligation, the net proceeds from that loan are treated as amounts received or collected in that year, essentially accelerating the gain.
Pledging the note can trigger tax.
Right. Finally, gain from the sale of depreciable property to a related person is generally ineligible for installment sale reporting, as this rule is designed to prevent tax avoidance between closely connected parties. And the installment method is not available for sales of stocks or securities traded on an established market.
Can't use it for publicly traded stocks.
Correct, as these are typically sold for immediate cash or cash equivalents.
Okay, that's I. And finally, to complete our HIDOT acronym, the T. A quick note on how corporations handle their own stock transactions. This might seem niche, but it's important for understanding the full picture of non-taxable dispositions.
Right. For completeness and to tie everything together, corporate transactions dealing in their own stock, things like issuing new shares to investors, buying back shares from the open market known as treasury stock, or even reselling treasury stock, are generally exempt from gain recognition.
So the corporation doesn't pay tax when it issues or buys back its own stock.
Generally, no. And conversely, any losses on these specific transactions are disallowed for tax purposes. This means corporations are essentially precluded from either receiving tax benefits, deducting losses, or incurring income taxes, recognizing gains from these specific dealings in their own stock.
Why is that?
The underlying reason is that these are viewed as capital transactions between the corporation and its owners, not as income-generating or loss-generating business activities. It's a very specific rule designed to simplify the tax treatment of these internal corporate capital restructuring activities, preventing the manipulation of taxable income through what are essentially internal equity adjustments.
Okay, so T is for treasury stock and capital stock transactions by the corporation itself. Got it. So there you have it. A deep dive into the powerful world of non-taxable dispositions. We've navigated the crucial distinction between a realized gain and a recognized gain.
Super important distinction.
Explored the incredible benefits of the homeowner's exclusion. understood the compassionate rules around involuntary conversions, clarified how property settlements and divorce are handled, delved into the strategic advantages of like-kind exchanges for real estate,
Especially for real estate now.
and learned how installment sales can effectively spread out your tax bill. This isn't just dry tax law. It's a detailed map to keeping more of your hard-earned money by cleverly leveraging the provisions designed to support economic activity and personal financial continuity.
Well said.
Knowing precisely when a gain can be excluded or deferred is incredibly empowering, allowing you to make smarter, more informed decisions about your most valuable assets. These insights can truly redefine your financial planning.
Absolutely. And this deep dive raises an important question for you, the listener. Which of these provisions might directly apply to your current or future financial plans?
Yeah, think about your own situation.
Are you considering selling a home, perhaps exchanging an investment property, or looking to sell a business asset over time? Understanding your adjusted basis in these assets and how these specific rules hide IT apply can profoundly shift your entire financial outlook.
Basis is key.
Remember, knowledge is most valuable when it's not just accumulated, but truly understood and then applied. These rules aren't just for tax professionals to navigate in a vacuum. They're vital tools for everyone to be a more informed, proactive participant in their own financial journey.
Absolutely. As you go about your day, think about this. In a world of increasing financial complexity, how many other non-taxable dispositions or similar strategic tax provisions are out there waiting for us to uncover them and use them to our advantage? The journey to being truly well-informed about your finances is continuous, and the rewards can be absolutely substantial.